This video is part two of Introduction to Stocks. So, once you've decided you want to buy stocks, exactly how do you go about doing that? Well, the first thing you need to do is decide which company you want to buy the stocks through, or which investment company or which brokerage company, also called a brokerage firm, do you want to open an account with? What a investment company or brokerage company does is these companies help people buy stocks. They act as a middleman between you who want to buy stocks and the sellers of stocks. For facilitating that buying and selling, they charge a fee. Some examples of brokerage firms or investment companies are Vanguard, Fidelity, Charles Schwab, E Trade, and the sort of newest company is Robinhood. There are a lot more companies that help people buy stocks, a lot more brokerage companies, investment companies. These are just some of them. So once you've decided which company you want to buy your stocks through, the next step is to actually open an account with that company. Uh, for most companies, you can set up an account online without ever talking to anybody. But every single brokerage company, investment company has an option where you can actually call in, and there will be somebody there who will help you walk you through the step by step process to open up an account. Remember, this is basically their entire business is to act as that middleman helping buyers and sellers. So there will always be somebody there who can help you open an account over the phone if you'd like. So once you've opened up your account, you need to connect that account to your checking account at a bank or a credit union, and then move money from that checking account into your brokerage account. This whole process will probably end up taking somewhere between 2 to 4 weeks. Once you have a open account with money in it, you just go to the investment company's website or app, and on that there will be a way to buy stocks. When you're buying stocks, you will be charged fees. Uh, Number one fee is a commission. A commission is a flat fee for buying or selling stocks. For example, $4 to buy or sell up to 1,000 shares. For most people, it's a flat fee. If you buy a tremendous amount of shares, then it could be a little bit more. This particular commission, nowadays, a lot of companies actually do not charge this commission anymore. Uh, the second sort of fee you have to deal with when buying or selling stocks is the spread. The spread is basically the difference between the price to buy a stock and the price to sell a stock. The price to buy is called your bid price. The price to sell is called your ask price. And the price to buy a stock is always going to be a little bit higher than the price to sell. So if you were to buy a stock and then immediately sell it, you would still lose money off the difference between these two. And that difference is generally called the spread. So you have these two very general fees, the commission and the spread, and combined, this is the cost of buying and selling stocks. This cost has actually been going down for a very long time. As you can see, this is the average one-way transaction cost. So this is the cost to either buy or sell. And they have this as commission plus half of the spread. If you just double this, then this is the cost to buy and sell a stock. On your y-axis, you see this is the cost as a percent of that transaction. So if you are buying $100 worth of stocks and you are paying this 1% transaction cost, that means you're paying 1% of that $100 or $1. So as you can see, going from, to say, about the 1930s through the mid 1970s, the transaction cost was slowly increasing. But since then, transaction costs have quickly come down. The coming down has just been because of greater competition between these different firms trying to get people to use their company instead of the competitor's company. This is especially true with the invention of the internet. That has really brought down the cost a lot that companies charge. So you now have the money there in your brokerage account in order to buy stocks. So how do you decide what companies to buy? Well, companies fall into many different categories. So I'm going to talk about some of the categories for different companies, and you can use these categories to sort of decide uh, to narrow down your search of what type of companies you might want to look into. First, you have growth versus value. So one way of dividing up companies is into these two different strategies. And most companies use a combination of growth and value, but some companies fall more on the growth end, some companies fall more on the value end. So when you talk about a quote unquote growth company, this is a company that might not actually be making much money now, and in fact might even be losing money, but the company is growing very quickly or is promising to grow very quickly. Investors will buy into the stock in the hopes that once the company is large enough, they'll start making a lot of money. Many technology companies fall into this category. For almost every single technology company, when they first are a company, they make almost no money, and in fact, probably lose a lot of money. But they're growing very quickly. The amount of revenue, amount of money coming in, amount of product they're selling, or amount of people using that service is just growing very quickly. So even though they're not making money, they're still a company that some people might want to invest in. A very good example of this is Amazon. Amazon's revenue, or the amount of money coming in, has been growing about 20 to 40% every year for a while now. Here is a chart, or two charts actually. The blue one here is their revenue, how much money is coming in through the stuff they sell or the services they sell. And so as you can clearly see, it's been going up this whole time. This is, each bar represents a quarter. If you notice these much higher ones, it sort of follows a pattern. You have this tall one and then three smaller ones, tall one, then three smaller ones. And that taller one represents the fourth quarter, where it includes Christmas. So typically, there's a larger bump here for Amazon during that fourth quarter. Now, here in the green, it is talking about revenue growth. How much higher is their revenue this year compared to the same time last year? And it has fluctuated, but in general, it's fallen between this 20 and 40% for now 14 years. So if they're growing their revenue so much, and how's their profit? So this darker line is their revenue for Amazon from 1997 to 2015. And this is in billions of dollars. And as you can clearly see, their revenue has gone up, up, up this whole time. This orange-ish line is their net income. It is how much money they bring in minus their costs. And as you can see, their net income has basically stayed pretty flat. If we were able to zoom into this orange line, you would actually see that they lost money many of these years. And they're easy to see that their net income is definitely not growing the same way their net revenue has been growing. So this is a clear example of a company that is trying to grow as fast as they can and worrying about profits later. Here is a zoomed in picture of just their profits for that quarter. And as you can see, this goes all the way back to 1998, 1997, and here's the zero line right here. And a lot of these years, a lot of these quarters, Amazon was actually losing money all the way into 2014. They're still losing money some quarters. And even on the quarters that they did make money, it was not a lot of money. The 0.5 means $500 million, which is quite a lot of money. But let's look at this 2015-ish time when they made $500 million. If we look at the revenue in 2015, that was off selling about $105, $110 billion worth of stuff. So after selling $110 billion worth of stuff, they were still only making less than $500 million. So about 0.5% of the amount of money coming in do they actually get to keep as profit. So that's a clear example of a growth company. Let's look at value. So a value company sort of is categorized as the exact opposite. They're a company that is making a good amount of money right now compared to their stock price. And these value companies usually are growing, they're just growing very slowly. The industries that sort of fall into this value category tend to be older industries. So car companies, those companies tend to be value companies, phone companies, airline companies. These value companies may have grown really fast when they were first new companies, but by now their growth has very much slowed, and they've fallen into sort of this value category of slow growth, but are making money right now. These value companies also tend to pay an okay dividend. Okay, so there's your sort of value compared to growth. There's actually this third category that gets talked about a little bit less, income companies. And these are companies that have pretty high dividends compared to their stock price. They might be a company that actually gives back most of their profits to their investors as dividends. These income companies uh, will either be growing slowly or sometimes not growing at all. One sort of very stereotypical income company are utilities. Utility companies don't grow very fast. And when I say utility companies, I'm talking about your gas, your electric, your water. So these companies don't grow very fast, but they have a very, very, very steady income. People are going to use their electricity, people are going to use their gas. And so these companies have very reliable revenue, and sometimes they will uh, pay a lot of it back to their investors in forms of dividends. So you have this category of companies. They're either a value company, a growth company, something in between, which they might be categorized as a blend company if they're kind of right in the middle there. You have some companies that are categorized as income companies. Companies are also categorized by what type of business they do. We call that the sector they're in. And here are the 11 sectors that companies fall into. You have your energy, such as coal companies, gas companies, oil companies, material companies, uh, industrials. Uh, this might be your makers of, say, farm equipment. Consumer staples. Staples are the things that just people always buy pretty constantly. Your toothbrushes, your toothpaste, um, your soaps, paper towels. These are things that uh, people just regularly pick up. Consumer discretionary. The word consumer, by the way, is you and me, people who buy and then use it. Consumer discretionary are things that consumers don't have to buy, but that they buy. Uh, like I guess like jewelry would fall into this. A good amount of electronics fall into consumer discretionary. Then you have healthcare, financials. This is talking about banks, information technology companies. Um, like Facebook is an information technology company, so this is just technology companies dealing with a lot of information. Your Googles, telecommunication, phone companies, internet companies fall into this, utilities, real estate. These are the different sort of sectors that companies fall into. So that's one way you can look for a particular company you might want to invest in. Maybe you decide you think healthcare is going to be a great industry to be part of in the next 5 years. So maybe you'll start looking for healthcare companies to invest in. Companies are also categorized by where is that company. Two general categories, it's international versus domestic. Domestic just means that the company's headquarters is inside the US. International means that the company's headquarters is not in the US. International is also divided even further into developed and emerging. And the categories of developed companies, you can kind of think of them as the rich companies, the uh, rich per person companies, people with yeah, and these countries are the U.S., Canada, Europe, Japan, New Zealand, Australia, Singapore, and there's a few more small countries that are also categorized in the developed country. I believe Israel is also in this category. The emerging countries are the rest if they don't fall into this higher income category, then they fall into this lower income category. Companies are also categorized by how big that company is in terms of um, their stock market price times how many shares. So the price to buy 100% of the company. So this is what I mean when I'm talking about size or market cap. Cap here stands for capitalization. So a lot of times you can search for companies based on their size. These are the sizes I gave you in the previous video, but a lot of times on websites they will just show this: large, medium, small. Medium is a company with a market cap between 2 and 10 billion, where large is anything bigger than that and small is anything smaller than that. All right, now I've talked about how to search for different companies. Uh, if you want to buy the stocks for an individual company, I want to now talk about some pitfalls that people who buy stocks in individual companies tend to fall into. Pitfalls is just something you have to look out for, something to be careful about. One, people who do this tend to often try to time the market. What does market timing mean? So we all like the idea of buying right before the market goes up and then selling the stock right before the market goes down. That's right there, market timing. You're trying to figure out when the market is going to go up so you can buy, and then figure out when the market is going to go down so you can sell right before that happens. So the problem with this is that you will probably fail at timing the ups and downs. No one can really consistently tell before it happens when the market's going to go up and when the market's going to go down. There are some people who are a little bit better than others, but there is nobody who can consistently figure this out. And this includes the professional people. So if even the professionals are really not able to consistently figure out when the market's about to go up or when the market's about to go down, then you and me, we're just not going to do it. It's not realistic for us to be able to time the market. And that's because the market, a lot of times, behaves in a way that is, for us regular people, doesn't seem to make sense. Let's take the year 2020, for example. Okay, so in the year 2020, in around the January-ish time frame, Australia was burning. We get into February. COVID has already been in Asia and has spread into Europe. So here in February, the market starts going down, which is what most of us would think would start happening. But if you remember back in the February 20th, it hadn't really taken hold in the U.S. that strongly yet. So maybe you would have been able to predict that it was going to start wrecking the economy, but maybe you wouldn't have. So it goes down. Sure, maybe you could have figured that out, but March 23rd was the bottom of that. And then the stock market just started going up. And I think very few people would have predicted this. March 23rd, it was still at the sort of mid the beginning of that first wave of Corona, where businesses were shutting down. There was cities sort of just shutting down their whole economy, shutting down schools, shutting down businesses, and the stock market started going up at this point. And then it kept on going up. And during the summer, when we had a second wave hit the southern US, and lots of people down in Florida, Texas, um, Alabama, Georgia, like there was widespread uh, COVID happening in those areas, which were affecting that economy. Well, the stock market just kept on going up. And you see this tiny little dip here in that looks like maybe the beginning of September, maybe the end of October. But basically, during this third wave, where we're top 250,000 people dead in the US, topping 300,000 people dead in the US, people getting um, you know, people getting sicker and sicker here in the US. Still, the stock market continues to go in a general upward trend. So I don't think many of us would have predicted that this is what would have happened, because this is not our experience with how the economy is. So don't try to time the market, because what usually ends up happening is people will end up doing the opposite of this. There are lots of people who tried to time the market, and when they saw the market fall from February to March, they sold all their stocks, and then they missed out on this whole big rally. Or maybe they got all the way up to, the summer, and then they're like, "Oh, it's starting to get bad again. Let's sell all my stocks." And then they missed out on the gains from the summer through the end of 2020. So, pitfall number one: don't try to time the market. You're probably not going to be able to do it. Pitfall number two: even though this video has been talking about how to buy individual stocks, how to uh, how to look at companies in these different sectors, look at companies that are either value or growth. In general, buying individual stocks for individual companies is actually not the best way to buy stocks. Stay tuned to future videos for us to talk about what is the best way to buy stocks.